Right.
All right. Well, we have James Sullivan now joining us, Managing Director, Asia Pacific Equity Research at JP Morgan, to sort of tell us what he's making of the global situation. James, great to have you with us here. Thank you very much for your time. It's always a pleasure. Let's just start with what market prices are telling us, James, and let's just focus on U.S. rates. Yields sold off. They were down about 20 basis points last week. Is this a function of what the Fed has been saying, which has been quite dovish recently? Or is it geopolitics at play? What's your sense?
So there's multiple factors being priced into all markets right now. I think in particular to U.S. rates, the JP Morgan forecast is that the Fed will remain on hold in November. That is consistent with recent commentary from both Fed hawks and doves. I think the critical thing to look at in terms of the U.S. economy right now from a macroeconomic perspective are the cross currents that you're seeing between monetary policy, where you actually have seen significant tightening. You've seen the private cost of borrowing go up significantly, as well as a strong dollar constraining future economic activity. The flip side of this, and this is important because it is starting to change, is the fiscal policy out of the United States, where incrementally you've seen a 3.6 percentage point of GDP increase in the U.S. federal deficit on a year-on-year increase. That's a very large increase that is going to wane moving forward, however, particularly if you do not elect a Speaker of the House. Automatic sequestration will start to come into effect and dramatically reduce government expenditures in the United States with the ensuing drag on the U.S. economy. So we are seeing very clear cross currents, with a big positive being taken out of the picture on a relatively short-term basis.
All right. James, good morning, and thanks a lot for joining in. For a market like India, this has been a really good year. Not so much for the frontliners, but a lot for the broader markets, right? The mid-cap index has done very well. And now a lot of the bad news has been sort of overlooked. The market has moved on, just giving us even more conviction on the upside. Do you think that it makes sense to put money afresh into the Indian markets at this price?
So as you know better than I, India is a very large, diverse country, so there's always a million stories to talk about. But today, let's focus on two together. One is the long-term structural story of the changes that we're seeing in the broader Indian economy. On JP Morgan forecast, we're forecasting a more than doubling of manufacturing impulse to overall Indian GDP from roughly 17% today to roughly 25% moving forward. We're seeing a more than doubling of Indian exports from just under $500 billion today to over $1 trillion. And from a longer term perspective, by 2030, we see the Indian economy more than doubling to $7 trillion US. As it makes that journey in 2027, it will become the third largest economy in the world. So I would argue that we are seeing a structural transformation of the Indian economy from a medium to long-term perspective. From a short-term trading perspective, the Nifty generally tends to post on average about 13% positive gains in the 6-month period moving into an election cycle. So we have short-term tactical positive drivers, and I would argue very, very strong long-term tactical drivers that makes India a key overweight from a structural perspective from JP Morgan.
Good morning, James. Nigel on this side. That point on India is very well taken. And, in the longer term, we are definitely likely to do much better than our peers said. But what about China, the rank underperformer? Valuations are looking, fairly attractive, so to call it. But data points are still in a bit of a tizzy. How do you approach that market? Because everything's good at a price, right? Is China at that price, or would you all avoid it?
No, it's an absolutely critical point for us. So we are overweight China, with an expectation for a potential fourth quarter 23 or first quarter 24 rally. And the building components to that are very much in line with some of the points that you just raised. You have record low valuation levels. You have institutional investors that remain extremely underweight in their positioning in China. And really the critical thing for us to focus on here is the potential turnaround that we're starting to see, particularly in the August macroeconomic data points, where you saw fixed asset investment, you saw industrial production, you saw retail sales, all beat to the upside. At JP Morgan, we run a quantitative indicator to try to understand what stage of the business cycle an economy is in. And for China, that moved into the recovery stage for the first time in a long period of time. The one last data point that I would push from a China perspective is that you're seeing earnings revisions currently 1.5 standard deviations below the average since 2005, which is generally a time of peak negativity and the beginnings of an inflection point. So we do think that the data points are starting to show the potential for a fourth quarter, first quarter rally in China.
So in the near term, James, would it be leaning more towards China than India?
So it depends on time frame and it depends on investor risk appetite. From a longer term perspective, again, we see these massive changes in the overall structure of the Indian economy, which present very clear opportunities for sector selection within what we think will be a strong overall market. In China, we're very, very focused on specific sectors. If we can focus in line with government policy, if we can focus in deeply beaten down sectors that offer significant valuation support, then we see opportunity. So it's a slightly different portfolio allocation strategy in each market.
All right, James, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. So that's how you can approach the markets, both in India as well as across the globe. But let's do one thing. Let's take a quick break. On the other side, I'll